see that we have enough interest in Mint that we have to have the ballroom to use. Usually we had, over the last 6 months, we could accommodate most people with a table of 5. So, but I guess the share performance in Thailand's recovery has gotten everybody a little bit excited. So I think with that, let me get right into our presentation. I'm going to take you through our first half performance recap, some recent updates, a little bit on our restaurant business, a bit on our hotel mixed use, and other information which you can get from our IR department. But first, on the first half recap, the biggest news probably has been what we bought with Sun International. We made a very interesting strategic purchase in Africa with Sun International, and that's given us a hotel in Zambia, a couple of hotels in Botswana, Namibia, and Lesotho. And so we have 8 hotels there from Sun, and we got them all at a very good price and in a market that's growing very, very rapidly. But if we go back to our first half year, you can see that we managed to grow in the first half 10% year on year from the first half 13 in terms of top line. And we grew our bottom line 11% year on year. That's here. And in terms of profit, that was quite a significant number, because in our first half this year, we've done about 2 billion baht. And considering all of the problems that we've seen in Thailand, I don't think any of our peers are showing any growth. So we're very pleased with this growth. If Thailand had had a first half that would have been reasonable, like we've had in most periods, we would have had phenomenal performance. But stand by, because I think we can see Thailand under good control right now, and that's going to result, I think, in a very strong second half. And for the hotel business, it's really all in the fourth quarter and the first quarter that we see real money made. To give you an idea of our international presence today, we're in 33 countries across the world with our hospitality and restaurant business. And right now, about 38% of the revenue came from our international operations and 62% from Thailand. But if I was to analyze where we had our assets, a majority of our assets are still buried here in Thailand. And we have what we call an asset-right strategy. We'll tend to invest wherever we can get a good return. We get good returns from Thailand. We get good returns from the Maldives. We get good returns from many of from Vietnam. So we've tended to invest in those countries, in Indonesia. So where we don't invest is where we see very high real estate prices, places like the Middle East. We own no hotels in the Middle East. We have 10 in Dubai and Abu Dhabi alone, but we manage them. We have 4 or 5 in China, but we only manage them. And these are great hotels. There's probably about 3 billion in managed hotels that we manage for a fee, but we don't have any investments there. If we turn to the restaurant business, we really see that we're poised for very solid growth going forward. We've invested 50% recently to operate a joint venture with Bread Talk here in Thailand. That comes up after we bought about 11% of Bread Talk, public company down in Singapore. We see Bread Talk as a very astute development company that's got a huge presence in China, and we'd like to grow with them there and do more with them there. Also, we are now putting, because we can't find enough investment opportunities in the restaurant business, we're investing more equity in countries like India, where we've just bought 70% of the Swenson's operation. We'll also be opening our own coffee club operation in the Middle East. We just got the Grand Mosque. If you go to the Grand Mosque sometime in the next couple of months, you'll be able to have a cup of coffee from Coffee Club in Abu Dhabi. That's probably the highest traveled visitors spot in the Middle East. If we turn to some of the more recent updates, in Singapore, we had to go to Singapore to buy a Thai concept. We bought Thai Express down in Singapore. It's been immensely successful in Singapore. We've also taken it to China, Maldives, and now we've even brought it into Bangkok. We have a Thai Express in Phuket. We've launched another brand called Seafood. Singapore is a very, very competitive market. And so we use that as a place to try out new brands, and that's really helped us to keep our game above average. The other thing that we launched, we would like to be bigger in Thai food. We believe Thai food is what Japanese food has been here in Thailand, in other countries. In the old days, Italian food used to be the popularity, and there's hundreds of Italian restaurants everywhere. But Thai food has become extremely popular. But there's very limited and very spotty supply and delivery of product. So if you were to go to a Thai restaurant in somewhere in Europe or the United States or even in Asia, you may have a good meal, you may have a bad meal. It often starts with the people. And we've set up our own culinary academy now. Dusit has the Cordon Bleu to teach you how to do fine French cooking. We've got our Thai Cuisine Academy, which will teach Thais and foreigners how to prepare the best Thai food. And we've done that in a joint venture with S&P, our partner here in Thailand. A little bit on our financial performance in our restaurants. You know, if we take the first half year, we're up 12% year on year. EBITDA is up 6%, and net profit after tax is up by 4%. So our first half revenue of the restaurant business was really strong. And considering the difficult environment that we worked in, and the majority of our restaurants are still here in Thailand. As the environment now stabilizes, as we see, we think we're going to see substantial growth. It's all linked to consumer confidence. And today you have consumer confidence once again in Thailand, and we haven't seen that for many months. If you look at where our restaurant international footprint is, you can see that in the first half we had a revenue contribution of about 33% from our international operations, and still very strong from Thailand, because even in spite of political turmoil, people still have to eat. But we have been spreading our wings further and further afield, and we now have offices to look after those things in Australia, in Singapore, obviously in Thailand, and now in China. So we are growing our food presence, not only managed from here, but managed from our remote offices. People are very critical to our business, and we try to recruit the best in the world. Not necessarily the best in Thailand, we think we've already got them, but we try to also get the best in the world. It's absolutely critical if you want to be a world-class company, and we're critical and we're passionate about wanting to be world-class. We don't compare ourselves to local competitors. We compare ourselves to international competitors, whether they be Yum or Marriott or Starwood, whether it be in the hotel or the restaurant business. So that's very, very critical to us. What we've seen is some very good total sales growth and a recovery in spite of the difficulties in Thailand. We saw a recovery in same-store sales growth, which is an important number. I don't think any of our competitors saw that. And I can only attribute it to, since we all operated in the same difficult environment, to our management team. If you look at restaurants by geography, you'll see that about 35% of our restaurants are now international, and 65% of them are in Thailand. And if we look at the number of franchise versus owned units, you'll see that we own about 52% of all of our restaurants. 48% are franchised. That means they're on somebody else's balance sheet, and they just pay us a royalty, which is rather nice. If you were to look at a company that's been in the news recently, like Burger King, when Burger King first started being traded around by various companies, they owned about 25% of the restaurants. That means around 2,000 to 3,000 restaurants. Today, Burger King owns, I think, 6 restaurants. They have no more restaurants that they own. It's only a franchise business. It's only an asset-light business. There is no reserves to boost profits by selling restaurants. If you wanted to see really fast profits, we could sell off our 52% of all of our own restaurants and just collect royalties and lighten our balance sheet and make a lot of money. But we're in it for the long term. We're in it for the recurring values that we see, the recurrent earnings that our shareholders want. If we look at our Thailand hub, Thailand remains the major revenue and profit contributor to our restaurant business. And it's really been through innovative products and services, proactive marketing initiatives, as well as efficient cost controls that have afforded us, our restaurant business, to remain in the forefront of all casual dining in this country. And here you can see quite a significant same-store sales growth in the second quarter, as well as total sales growth. And a lot of this came from the pizza business. So we saw a good rebound in spite of the political difficulties. We've also launched a lot of new products with our different brands, and that's helped us to see that growth. It's very, very critical to be really on top of all these things, and especially with our own brands, where we're responsible for the research and development. So this is really something that we have to be responsible for. Turning to Singapore. Singapore, as I mentioned to you, is a very competitive hub. Let me go back. Can we go back? There we go, Singapore hub. Singapore is our second biggest revenue growth and net profit contributor of the restaurant business. We get 18% of our sales from Singapore. We own virtually all of our restaurants down there. Its net profit has had impressive growth despite negative same-store sales growth in the first and second quarter, because we grew a lot of new restaurants, and that tends to cannibalize. So we had a negative in the second quarter. We expect that to improve in the second half of this year. But the profitability remains very strong. So the second quarter this year, our profits were up 44%. In the first half, they were up 37% over last year. So this isn't disappointing performance in spite of the fact that we saw a downturn in same-store sales. We launched a number of new restaurants and new concepts, including Poulet, a roast chicken restaurant, Penang Street, and another Thai restaurant called Basil, as well as Seafood, which is a Hong Kong bunnery and ribs place. So we've got a lot of very exciting things happening in Singapore. If we turn to Australia, this is a franchise market. Only 1% of our revenue comes from Australia, but it contributes 11% to our net profits. Because in Australia, the wages are so high, you can't afford to run your own restaurants. We run very few restaurants in Australia. They're all run by franchise. Because that market, it's more effective and more profitable for us to run as a franchise. So down there, labor costs for a dishwasher, if anybody here wants to apply for a job, it's $22 per hour. That's, in an 8-hour day, that's almost $200 a day, not a month. And so just washing dishes is very profitable down there. And that's why we tend to focus on franchise. However, in Thailand, we own all of our coffee clubs, and we make very good money from them. They're a fantastic operation. Anybody in here not been to a coffee club? I'm looking. Wow. Only one person hasn't been to a coffee club? Then I'm really happy. 2? Okay. So please go to a coffee club and see for yourself why we're growing and why it's good. Great food, great prices, and that's why it's been successful in so many countries after we bought it in Australia. If we turn to our China hub, this gives us about 12% of our revenue. In terms of net profit, its operations have just turned around. We've been a long time trying to get China profitable, and I'm pleased to say that we'll be profitable this year. We're opening a number of units. We bought a Chinese restaurant chain called Riverside, and it's very popular. It's in Beijing and Shanghai and a number of other cities, and we're opening more and more of those restaurants. We found that the pizza business, we haven't been able to make that one work, so we closed a number of pizza company restaurants. But Sizzler, Riverside, Thai Express, and several others are doing very well, and we expect to see that grow considerably. So keep watching this space. If we turn to our hotel and mixed-use business, we continue to invest in our future, and we're very excited about our new Anantara in Phuket in Layan. For anyone who's concerned, it's on freehold land, which has been announced by the land department as legal. It's nothing, we're not part of all of these hotels that are being questioned. We're building a number of residences down there also. We've just recently bought the Radisson Hotel in Maputo, which is the #1 hotel in Maputo, the capital of Mozambique. We already have 3 other resort hotels, and we have another city hotel in Pemba. So Mozambique is another key country for us in Africa. We're also in Tanzania and in Kenya. And of course now with our move into South Africa, we're building enough so that we will have another hub in Johannesburg to look after our African operations. And we see Africa being even more powerful than in terms of potential profits than even Australia, which has been very, very profitable for us. You can see here a bit of a picture on the Maputo. We're building an office tower, a residential tower, and a shopping complex, as well as the Radisson Blu Hotel, which we will manage be the asset manager of. So we've got a big presence in Mozambique, and that's going to add to our African adventure. We continue to really to invest in opportunities there, like the Sun International. We spent about $62 million to buy the properties that we bought from them. We're remaining with Sun as a partner so that they're specialists in casinos. They operate casinos. We'll operate the hotels. They'll operate the casinos. And we think that we're going to be able to drive their business much stronger as a hotel operator focused on the hotels. We're confident they're going to do a very good job with their casinos. If you look at how we've been doing with our hotel and mixed use, in the first half of this year, let's see, you'll see that we had a 11% growth for hotel and mixed use, and we had a 11% EBITDA growth, and we had an 18% profit growth from our hotels. So this is really a very good performance, we believe, and founded on the basis of our strong international presence, because Thailand, as I mentioned, really has been holding us back. 42% of our owned hotels and mixed-use revenues saw revenue growth of about 1%, because most of our owned hotels, or many of them, are here in Thailand. System-wide RevPAR dropped by 5%, so we saw some real hits on that. Oaks, however, showed good growth, and while the currency was a bit weak, we're still very, very pleased with that operation. Our management contracts doubled from last year. Real estate is still contributing a very strong part of our operations, both Vacation Club as well as our whole ownership, like St. Regis, Chiang Mai, Samui, and now soon Phuket. And we will also be initiating a number of other developments in the real estate side, our mixed-use side, which will strengthen our earnings even further. A little bit on where we are from a revenue contribution point. In the first half, we had 51% of our revenue came from international. So that's the first time that we ever saw international be bigger than our domestic operations here in Thailand. And long term, it will be bigger. But I would say in the short term, probably even by the second half of this year and going into the first half of next year, I think we'll see Thailand become again the star performer in terms of revenue contribution. But you can see where we are around the world and where we have hubs or about to open a hub in Africa, in the Middle East, in Australia, and in Thailand. So, and finally, I think we'll need one in China very soon. So we're very decentralized with our operations. They operate from these hubs. They're very international, very multinational in the way they operate, and you can see the various brands that we operate throughout this network of countries and where we have an international presence. And it's 23 countries right now. And we have another 6 countries in the pipeline over the next 3 years. System-wide hotel operations, our second quarter 14 system-wide RevPAR increased by 10% year on year, despite the impact of the domestic political events. Excluding Bangkok hotels, system-wide RevPAR rose by a higher magnitude of 19%. So if Bangkok had had a good period, we would be in much better position. Fortunately, most of the major tourist destinations didn't have the problems that we saw in Bangkok. So Phuket, Samui, Chiang Mai all did very well. Bangkok continued to see growth in RevPAR, while overseas hotels, the majority of which are Anantara, witnessed even stronger performance, with RevPAR increasing by over 50%. Hotel operators in Thailand and in Bangkok especially are getting much smarter. People didn't drop their rates when martial law was declared or when the protests. When people don't feel like traveling, whether it's SARS or it's martial law, it doesn't matter how low you go with your rates. Nobody's going to come. It's not going to generate more business. So today what you saw is that actually it's helped almost all the hotels in Thailand, or Bangkok I should say, raise rates during a period when we had low occupancy. And as high occupancy comes back, you can expect those rates to stay up there. We don't need the lower rates. Thailand is already one of the cheapest markets in the world. You can get a room, a 5-star room here for a third of the price of Singapore or Hong Kong. So we don't need cheaper room rates. And there's plenty of rooms available. But here you can see a little bit the RevPAR drop in the second quarter versus the first quarter. You can see how high the fourth and the first quarter was. In spite of the problems, the second quarter is still above second quarter last year for RevPAR. So even though the occupancy has gone down to 60%, a lot of people may wow you with how high their occupancy is, but I look at it the other way. I love to see our low occupancy and rates like this because it means that if we get up to 70% or 80% at these numbers, you're going to see record profits. So that's where our growth opportunity lies. We can achieve this with just 60% occupancy. The number of hotel rooms that we have, we've moved them quite dramatically from second quarter last year where we had 10,000 rooms. Now we have 13,000 rooms. So we're up 24% in the rooms, the number of hotel rooms that we manage or own. If you look at our owned hotel operations, these are hotels that we own, like the St. Regis, Four Seasons, some of the Anantaras. The first half, we had a 42% contribution from hotels and mixed-use revenues, but the political instability of Thailand put pressure on overall owned hotels' occupancy, particularly that of Bangkok hotels. We were able to raise rates, as I mentioned, 12% on average. So we didn't lower rates, we increased them. And as a result of that, the revenue decline in Bangkok, RevPAR decline, was only 7%. So it was a very small decline in RevPAR in spite of the difficulties. So here you can see a little bit where the rates are, the number of hotel rooms that we've added, and the growth of our ADR in the second quarter in spite of some of the difficulties, as well as the drop in occupancy. So as the occupancy comes up, believe me, these numbers will start to really go to the bottom line, and you'll see some very exciting opportunities. If you want to look at owned hotels versus 10% of our owned hotels are in Bangkok, 90% are from other hotels and mixed use. So Bangkok really, even if they have problems again, which we never say never, we seem to have them a bit too often, problems in Bangkok, but it's a very small portion of our business overall. And as you can see, RevPAR excluding Bangkok was plus 4%, and in the provinces, RevPAR went up by 1%, and in Bangkok, RevPAR was down by minus 36. Occupancy fell to a low in the second quarter of 41%. Last year in the second quarter, it was 62. We had a 50% drop in our occupancy in the second quarter. This is huge, and this is all related to martial law. We hope that will be lifted, but we've already seen the confidence return. Warning signs from China and other markets have been lifted, and tourists are coming back, and they'll come back even faster when martial law is lifted, and I hope that that will be in the not too distant future. Overseas, you can see our RevPAR growth has been very strong, 12% growth. We have a phenomenal new hotel in Dubai next to the Atlantis Hotel. If anyone hasn't been there, please stop into Dubai. It's very, very good. We also have still strong operations going on with Australia. Roughly 28% of our revenue contribution comes from Australia, and there we've seen good growth in the number of managed rooms. We've seen occupancy go down a little bit because of the softening of the minerals market, and we've seen, although rates have remained relatively stable in Thai baht terms, frankly, in Australian dollars, they've gone down. So this has hurt us because of the weakness of the Australian dollar. But overall, we're very pleased with our investments there, and they continue to be highly profitable. If you look at our managed hotels, that only contributes about 7% of our revenue, but that's double what it was last year. So that's a significant increase from the 3% that we had in the first half of 13. System-wide RevPAR of managed hotels increased by 60% year on year, primarily from the outstanding performance of the Maldives, together with the improvement of other existing hotels and the addition of new hotels. You know, it's funny, a lot of people don't do too much research when they see Minor go somewhere, like the Maldives, then many other hotels follow. So I expect that you're gonna see, we've gone to Australia, there's a lot of Thai hotels going to Australia, there's a lot of Thai hotels going to the Maldives. Watch who goes to Africa next, because I think you're going to see a lot of them following. We tend to set the pace. But one of the things about having good numbers, it means that also the managed hotels and our owners also have good numbers. Without this sort of performance, the owners wouldn't have the sort of numbers and be satisfied with the management that we're giving them. When we start showing declines in numbers, then owners start to suffer, and that's when you lose contracts. A little bit about our pipeline in owned hotels. As you can see, we've got about 21% of growth expected in 2015, and what we have on the books is 7% for 2016. That will grow as we get closer to 2016. Oaks is going to grow by in 2015 by another 8%. That's a big base, remember, they've got a lot of hotel rooms. Joint ventures are gonna grow quite significantly by 92% because, again, we have the recent expansion with Sun. And the managed hotels are gonna go up by 26%. So we've got an awful lot of growth coming, and it's coming from all of our brands. You can see here the hotel investments that we're making in Anantara, also in Avani, and also in Paraquam and Elawana, and in others like the Radisson Blue and the Royal Livingston in Zambia. Management contracts, although we always say asset right, it's nice to be asset light. Management contracts don't require any investment from our side, so it's good to have some more of those. As you can see, we've got 2 more Anantaras opening in very quickly now in Doha. That'll be open this year, as well as 1 more in China this year. Then we have a number of units coming up in 2015. We have another Avani opening in December this year in the Seychelles. We have an Oaks opening in China. So we're actually getting a tremendous amount of growth in our pipeline. A little bit on the real estate business. This is an integral part of our hotel business. We don't feel we can be successful without having residential units as well as our vacation club. And all of this leverages off the Anantara brand, and it's growing, and because we've got quite a significant amount of growth opportunity coming from the Asian markets. So our membership, as you can see, China, 29% of our vacation club members come from China, 16% from Thailand, 13% from Singapore, 12% from Hong Kong. That means actually 41% from China. And most of it is Asian. We're not interested in the American market. If you ask me, the timeshare business is all fully saturated in Australia, in the US, so we're not trying to go there. We're only interested in Asia, and that's where the business is, and that's why we see it as such a powerful opportunity. You can also see where we have sales galleries and where we have currently AVC resorts, Anantara Vacation Club resorts, and it's pretty good coverage here in Asia, and you can expect that to grow quite significantly. On our residential side, we have in the pipeline, we've got Anantara Phuket, which will be launched in the second half of this year, and we'll start probably transferring ownership at the end of next year. We've entered into a partnership to develop service suites adjacent to the Anantara Chiang Mai, right in the city. So that'll be our first residential project under the Anantara brand in Chiang Mai. We'll also be adding more residential club suites in Phuket, and we have additional residential projects adjacent to other properties, both in Sri Lanka and in Thailand. So you can expect that this will continue to be a core business for us. We're not a real estate company. We're not a land and house or anything. Our development is primarily close to our hotels or linked to our hotels. The residents in Anantara Layan Phuket, which I mentioned, will be 15 of them. They'll be priced from $10 million up, that's 300 million baht or more. And they will go up in size up to 8 bedrooms. And they've got build-up area of nearly from 1,300 square meters to 2,300 square meters. These are very big, very prestigious houses. And I think to turn to a little bit more, retail has always been a very small part of our business. I think that in this 5-year plan that we're working on, it's going to become a little bit more important. We won't be able to announce those to you until we announce our third quarter and have our board approval on our 5-year plan. But we've been doing pretty well considering the lack of consumer confidence, and we're only in Thailand. So we only had 1% growth in revenue, and we saw a decline of 9% in EBITDA, and net profit was down 21%. But these are very small numbers. Remember, this accounts for only about less than 10% of our business comes from retail in terms of sales. And in terms of profit, a very small, not even less than 3% comes from retail. So don't spend too much time trying to understand it. We have seen sales growth, which you can see here, and we've seen a little bit of a decline on sales per square meter as things drop down. Probably the most important thing is our balance sheet strength. We have plenty of opportunity for acquisitions right now. Our credit rating was recently increased from A to A positive and by TRIS. Our leverage ratios are pretty well at an all-time low. Our CapEx plans, we have lots of room for new opportunities, and we have lots of backup financing available to us. So we're in a very conservative position in terms of our balance sheet. And if we look at our 5-year aspirations, and those of you who have been watching us for more than 5 years will know that in 2007 we had only 22 hotels, 676 restaurants, 316 retail shops. But our goal by 2018 is to be 160 hotels. I can tell you now our goal in 2019 is to be much, much higher than that, because we've already seen a rapid acceleration to our growth. We've seen a rapid acceleration to our vacation clubs and our residential use, so that should grow even faster. This is all based on last year's 5-year plan, which you've been looking at. Right now, we're already, I think we're even higher. When this presentation was put together, we were at 109 hotels. We've even gone higher than that. And restaurants, we're opening, as I mentioned, 2 a week somewhere in the world. So this will continue as we go forward. In summary, I think our 5-year strategy has been very consistent. It's built on 3 pillars with very clear goals and measurements. If we look at our net profit growth, we're looking at 15 to 20% CAGR every year. We've returned a tremendous amount of money to our shareholders. Total return to shareholders for the last 10 years has been 33% average per annum. And that's why we're one of the best performing stocks in this market. Return on invested capital is 16%. So when we can get 16% returns, don't expect us to give lots of dividends back because we tend to reinvest them. Our growth pillars are really driving profitable portfolio of our own brands. We've got brands like Anantara, Avani, Coffee Club, Thai Express, Pizza Company, Riverside Restaurants, Ribs and Rumps in Australia. So we expect our total system sales growth in both hotels and in food to grow by over 15%, and revenue growth of at least 10%. We're going to maximize our asset value and our productivity, mainly through our asset light and asset right, as well as our mixed use initiatives. You'll see an improvement in margins as our revenue goes up. We're keeping a very tight control over our overheads. And in terms of expanding internationally, you'll see us continue to be aggressive in strategic investments and acquisitions, and revenues from overseas should reach 40%. We know they were a bit higher in this first half, but that was really unusual because of Thailand. Net profit from overseas we expect to be at least 50%, because overseas business for us is even more profitable because we invest less money and it flows straight to the bottom line. So I think that was a fairly quick view of our company, and it's according to the timetable. I've got 13 minutes and 42 seconds to answer questions from anybody brave enough to ask me anything. I don't like to do these presentations because too many analysts feel they know how to run our business better than our management team. So I don't come very often, but you have me here. We employ a lot of consultants sometimes to help tell us about our business, and I can tell you my definition of a consultant. I'm not saying an analyst, I'm saying a consultant is a guy who knows how to make love 49 different ways, but doesn't know any girls. And that's really what consultants are like. And we've had a lot of them tell us about our business. With that, any questions? God, I've mystified everybody. Did anybody understand my presentation?
Okay, any questions from the floor? Please.
Yes.
This is probably nothing to do with the business, but I just want to get your high-level sense of, what you're seeing, the color in terms of why you think, things will get better in Thailand. Just your gut feeling, what you're sensing, what you're seeing through businesses.
Well, you're asking a person who has written a book on Thai politics. I'm in the second edition, actually, of this book, and you can get it from my secretary by making a small donation to charity. It's sort of like the Ice Bucket Challenge, but this book is about that thick, and every single page is blank, and it's everything I've learned about the Thai political situation in the last 50 years. So it makes a great notebook. It's all blank. You can fill it in any way you want. It's very hard to predict, but I would tell you that we've never lost confidence in Thailand. The fundamental strengths of Thailand, both in terms of its culture, it's a unique country. We've had really the best of many things. We've gone through ups and downs, but fundamentally, this is a very strong country. I gave up my U.S. citizenship to become a Thai, but in America, they talk about doing business for 250 years, but here in Thailand, they've been doing commercial business for over 2,000 years. And they've survived. We've survived through I don't know how many monarchies and reigns. We've survived through, I don't know how many, I've been through 7 coups, so that should give you some idea. Thailand will always go on. And I think we're going through a period of relative stability, of strength, and more transparency. And I think that's positive. There wasn't a lot of transparency in our system. There is now a lot of transparency. We've seen a cleanup of our beaches. We've seen rethinking on many of these mega projects, which is going to result in less corruption. And I think that's going to be good for the country, good for the taxpayers, good for the economy. So I'm very confident. We've never canceled or postponed any plans for any of our billions of baht worth of projects in Thailand because we have a fundamental belief And this is our head office, this is our home. So I'm very confident.
Okay, I have some questions from the audience. You recently announced 2 large acquisitions in Africa, a relatively risky place to do business, especially with the recent news on Ebola outbreak. What is the rationale behind your latest plan into the continent?
We only invest in high growth areas, and Africa is one of the highest growth areas. I don't know if anybody can remember SARS, but SARS was a time when the airport was totally empty, every hotel was totally empty. I've never seen anything quite like it. Ebola is not even that bad, but Ebola has been around for a long time. SARS has been around, SARS is still around, so that will pass. You know, it's amazing how fast countries jump back. I remember when the nuclear reactor went off through the tsunami in Japan, and everybody said, oh, who wants to go to Japan? You're going to come back green. Well, I can tell you, Japan now has more tourists now than they had pre-nuclear reactor, and they're not coming back green. So recovery is much quicker now. We have more incidents, but recovery is very much quicker. When we look at something like Africa, we look long-term, and that means we're looking a couple of years. For us, long-term is a couple of years. And in our 5-year plan, Africa is going to contribute a lot to our growth over this next 5-year plan. So that's why we've invested in it. It's got high growth. We've got great opportunities for our food business there, and we've got some great properties. So you could expect to see a bit more probably coming up in terms of investments in Africa, because they're well priced too. We factor in a much higher return in Africa that we have to get. So we generally get a higher profit there than we would in, say, Thailand.
Okay, and you mentioned high growth and high expected return. What type of expected return do you have for your investment in Africa?
Well, to give you an idea, normally our internal rate of return for a country like Africa is about 19%. If we're investing in Australia, we only look for 9% because it's relatively stable. They don't have too many coups. They don't have too much martial law, so it's relatively easy to invest in Australia. So we can take a lower return. So Thailand has about a 14% return that we require, minimum. Our overall average or target is about 16. I think the whole country or the whole company gets currently about 13% return on capital.
Okay, any questions from the floor? Please.
Hi, Bill.
Hi.
Going forward, which side of the business are you more excited about, the food or the hotel?
You know, it's funny. I'm excited about both sides. I'm passionate about both sides of the business. The thing that irritates me the most about the food business is we can't get enough acquisitions. The private equity firms are in there all the time, overpaying and spoiling the market, you might say. But if we could find more acquisitions in food, I'd love to have them. We've tried hard. We made a pitch for Pizza Express in London. We'll go anywhere in the world for the right acquisition. In terms of hotels, there's more opportunities because private equity is a little more scared of hotels. They've been burned badly. You don't need to go too far back to see Lehman and some of the other things. You can't flip hotels around just like that. And you've got to invest an awful lot of money. And so we see less competition for the sort of hotels that we want. You've got people like Marriott. They bought Protea, I think it was, in Africa just recently. They paid about, $150 million or $200 million for that. We looked at it, we declined. We didn't want to go after it. We went for Sun because we saw more returns there, higher profits at a lower investment cost. So we're very pleased with that. But we just have more opportunities, I would say, to recycle money. We are spinning off. We don't have to invest very much in our restaurants. The cash flow is so strong. So the only place we can invest tends to be in the hotels, where we can get good deals. And don't underestimate the importance of the hotels in terms of other aspects. We just finished building a new hotel in Gladstone in Australia, and we have a ribs and rumps and a coffee club there. Anybody who's been over to the Anantara Bon Ropersong service apartments will see a coffee club there. So we've just opening another coffee club in the Oaks Adelaide Hotel. So we get a lot of synergy from both of our businesses. So even though the hotels may grow, they open up more opportunities for the food business. And in Africa, you can expect that we'll go after a food business in Africa. So that will be a very exciting opportunity, and we'll have a lot of resources in Africa because of the hotel group. So this is what happens. We went into the Middle East first with the hotels, then the food came along, and now we have equity in our food business there.
Okay, this question is about doing business in China. China can be a very tough place to do business for outsiders. What made you decide to enter such a difficult market? Do you still believe that it was the right choice?
Yes, I do, but many of the analysts don't agree with me. We lost about $50 million. We're just now making money. But I just believe that China is such a huge market, which has so much huge consumer purchasing power. Look at what is going to happen with all of the dot-coms and everything in China, and selling, whether it's Amazon or whatever. So to me, you have to be in China to be a player. And it's not easy, and you better be prepared to lose a lot of money before you're going to make any money. But we were prepared, and I would say this is one time when we didn't listen to the analysts. I remember also analysts telling us that we shouldn't be building another hotel in Bangkok, the St. Regis. They said, how can you invest 1/3 of your equity into a project here? Well, I can tell you that's one of our most successful projects. I'll predict that China will still be one of our most successful long-term projects, just like Africa.
Okay, any question from the floor? Please.
Both in hotel business and food business, do you recycle assets, and do you pay attention to the fact that there's certain pockets of in country where there could be oversupply of hotels, and if you don't foresee a situation of making money for the next 5 years, do you recycle assets? And that's question one. And question two is, your complexity of the business has grown tremendously in the last 3-4 years, both in terms of geography and and type of products that you're building, etc. So what have you done internally from a management standpoint, and how much have you invested and hired people, etc.?
Okay, I got the first question. I still need a little help on the second one, but the first one, let me try and answer that, and then I'll take on the second one if I got it right. But the first one, we'll look at anything. We're looking at REITs all the time. We're looking at splitting the company, whether it could be 2 vehicles. But the whole thing tends to be focused on shareholder value. If we can get more shareholder value, then we'll look at it. Right now, in our current 5-year plan, we see greater value. We review this every year from being combined. So don't expect us to split it. Don't expect a REIT right now, because we don't need much cash and it's hard to get it. And frankly, why should I pay 6% to a holder of my assets, these fantastic assets that we bought and we've grown into profitable things, when we can get money and we're borrowing our own money at 4%. And we believe our shareholders like our assets, and that's why we get a higher valuation. In terms of this competitiveness of the marketplace, I think that to me, it's all about focus on people. If we're going to be innovative and compete in this very competitive world, and Thailand is a very competitive market. Every brand you can think of is here in the food business. Every brand is here in the hotel business. And if you can compete here at these low rates that we see in Bangkok, then you can compete just about anywhere in my belief. So, but it's all about people. Even great brands can fail. We've seen brands fail, McDonald's in certain countries. We've seen KFC fails. We've seen lots of people fail. But it comes back to, I don't mind what brand it is. It's the quality of the people. I think the success of the pizza company in this marketplace is because we've got the best people focused on building that brand and operating that brand. So we're up against Pizza Hut. We don't lose any sweat or sleep. So the problem that we really do, it keeps us on our toes. We're also an unusual company insofar as that we have some, for example, Four Seasons, St. Regis, which is Starwood. We have Marriott. We now have Radisson. We watch what they do. We measure ourselves against those world-class players, and we know that our brands have to be better than them. We measure the pizza company against Pizza Hut. We measure all of our operations, Swenson's against Baskin-Robbins, and if we can't beat them, then we know we're doing something wrong. And so we're not afraid of competitors. We welcome competition. It really brings out the best in us, and it focuses us on getting the best people, because we can win with our brands if we have the best people. You don't need the best brand. You know, Burger King is a highly profitable business for us. And we built that. It used to be highly unprofitable in Thailand. And the first franchisee, which we won't name, was happy to see it go away. We also had the Pizza Hut business, which was highly profitable for us. We were very unhappy to see it go away, and we had to start another pizza business. And today, guess what? Those people have let that business go away too, because it doesn't make any money, and we're very happy with our business. So what was the reason? The reason was people. Great people. Focus on people. And you as analysts, when you come to look at our companies, look at the people as much as you look at the assets, because that's what really tells the good players from the great players. And I think that our focus is very much on people. I see my time's up. The red light is flashing. So unless the moderator wants to give me any more questions.
Oh, there are a few questions, if I may ask. Now that Mint is reaching a sizable scale in terms of market cap, are you considering separating your hotel and mixed use and your restaurant business into two separate listed companies?
I think I just answered that question, but we're always looking, but so far we've been giving our shareholders the return by being together. And it helps management to operate more strongly with all of our, they're very similar businesses, you'd be surprised. We don't let Burger King managers run Anantara hotels, but by the same token, we do find that we get a lot of strength. Today we have a very big business in the Maldives in food, only because we were there in hotels. We do $12 million a year in our food business with Thai Coffee Club, Burger King, Thai Express, and all of that. But it would never have happened if we hadn't been there with our hotel business. So if it ever comes, we will look at it.
Okay, and let me end this seminar with this question. What is your succession plan? Who will take over when you retired?
That's a loaded question. Let me put it this way. There is a succession plan, and it's known by our board. And if I fall over when I leave the room, then my suggestion to you is it's a good buying opportunity, because the share price might suffer a little bit, but it's going to recover very quickly because we have an excellent pipeline. And we have a very good board of directors, and I think our good governance scores are some of the highest. We're a 5-star rating here by the SET, and I think it's because we really try to think through all of our potential challenges. You know, we all face the same challenges, whether every company faces succession planning challenges, every company faces the political instability of Thailand, but it's how the team deals with it that makes the difference between the various companies. We've all got the same 24 hours in a day, but it's how we spend that 24 hours that makes the difference between how successful we are. So.
All right. Okay. Thank you very much. Ladies and gentlemen, please give big hands to Mr. William E. Heinecke.